Welcome to the Dollars and Cents podcast. If you're not already familiar, this is the place we discuss some of the most interesting and important personal finance topics. So do hit the like and subscribe buttons to follow us. Today we're recording an on-site at the Insure Expo 2025 organized by CIMB Singapore. This year, the theme is From Protection to Prosperity. This highlights how insurance and investments play complementary roles in our financial lives. In this episode, we are going to discuss a common word of wisdom in the financial markets, especially when the markets have crashed. Should we always rush to buy in the dips, referring to the investment markets in the aftermath of a crash? This, of course, is in reference to the volatile stock market swinging up and down on a near daily basis. Just to unpack a little bit of what's happened, on 5 April, US President Donald Trump announced sweeping trade tariffs, and over 2 days, the S&P 500 crashed over 10%, wiping out $5 trillion in market value. This move was so unexpected that PM Lawrence Wong gave a ministerial statement in Parliament highlighting the economic implications for trade-dependent Singapore. And inexplicably, President Trump issued a 90-day pause on all the tariffs several days later, and the markets recovered some of the losses. So to strategize some possible moves, I'm delighted to have founder of the 1M65 movement and good friend Loo Cheng Chuan on this episode. Besides building a $1 million nest egg in the CPF, he's also a proponent of the S&P 500 index and has experienced several market crashes over the past few decades. Thank you for joining the podcast, Mr. Loo.
Thank you for inviting.
Okay, so first question. With the benefit of hindsight today, we know the broad markets have always recovered after each and every crash in the past, right? We can see the charts. Is every market dip a buying opportunity, or are there situations where it's better to stay on the sidelines?
When it comes to market crashes, I would say that almost all market crashes have its own unique peculiarity. It goes up and down quite a lot, and it's of course driven by Donald Trump's mood and fancies. And of course, I would say that at some point in time, it could turn out to be a great opportunity, but it also could be something at a great risk as well. And we have to evaluate. I would say that almost all crashes is an opportunity. Whether you should participate really depend on the individual.
Talking about individual, right? And you are a crash investor, like you said yourself. Have you bought any of the dips in the past market? I'm assuming that's going to be yes. And I just want to find out from you, what are some of the personal lessons that you have learned when doing so, both good and bad?
I started crash buying in 2007. That's after, of course, I formed my financial safety net, my CPF, and I accumulated some dry powder. So in 2007, when the market crashed, I was kind of expecting it to happen, although I don't know exactly when and how far. So when the market happened, I was like, wow, I finally got it, right?
Yeah.
And as it crashed, somewhere around the 40% point, I started going in. And at that point of time, I was still young and naive. I went into the STI index, okay? And I put a little bit into the S&P 500, and I still remember, I bought some OCBC stock as well. OCBC that by then was $5. I still held on to it until today.
I mean, it's a good return.
That is very good. The S&P 500 also held on to it today, but unfortunately too little. But a huge bulk of it was in STI index. So it did went up, and of course, I always call STI index a super terrible index. It went up, but it was just miserable. But that was then where I first learned the lesson: what you buy matters. Okay, it's not that everything crashed, you should buy, and you should only buy things that compound, have a track record of compounding and surviving crashes. So that's the first lesson, and subsequently, I also realized that I go by percent crash. Okay. Some people say, is it maybe 30%, 50%? Yeah. Then I realized that each crash are unique. Mm-hmm. Some 20 and it back, and some went down all the way to a cutthroat level, and then it go up again, and some V-shape, COVID, super V-shape, and some super U-shape. They take a long time, like 2022. So every crash has its own peculiarity. Then I realized that we have to study each individual crashes to identify each uniqueness.
Right, okay.
I've said it before, I'll say it again, that it is okay to miss a crash, right? It is not okay to die in a crash.
Yes.
Yeah. So I think that I think we got to learn that.
So just going back to what you say, what are some of the things that you look out for in individual crashes then? Maybe just from a personal perspective.
I know I always brag that I can do bottom fishing, but That's not exactly true. I only catch around the bottom.
That's good enough, I think. Good
Well,
enough.
around the bottom, it's easy to say, but it's very difficult to do from. It's easy to identify around the bottom. It's very difficult to execute around the bottom.
Right.
So right now, everybody is rushing the market because that's the beginning part of it. Many people fail to realize that most of the crashes, with the exception of COVID crash, take months and sometimes even years to fish out the bottom. And at the bottom, generally there's a lot of corpses and carcasses. There's a lot of blood in the streets, so it will be painful. Economically, there'll be job losses, there'll be pay cuts whatsoever. I came to realize over the years that it's very difficult to predict what's happening, but it's very easy to see where you are. When the COVID crash happened, we know it's very, very bad. But when Federal Reserve started QE Unlimited, then I realized that, how bad the situation is, he's there to mother hand you, right? So the market really went up by about 5-10%. Then I realized that I can go in.
Okay.
So I missed the bottom.
Yeah.
It's okay, right? You don't catch it exactly. Now, the one I really caught the bottom was 2022, when there was a great inflation. And I was just lucky. I caught it when I started realizing two things. Number one is that inflation needs to stop. And the first sign of inflation stopping is when price stabilizes.
Okay.
Everybody was waiting for price to fall. There was a big economic misconception. You just need to stabilize. And when I saw the raw material, lumber, pork, beef, foodstuff, and some of these things, the futures market starts stabilizing.
Right.
Then I realized, oh wow, that's the time to go for the Q.
Okay.
So there are signals on each unit peculiar. I must admit there will be times where I cannot find the signal.
Yeah.
And it's okay to stay out of it.
Yeah.
Yeah.
Like you say, right? It's okay, perfectly okay to miss market opportunities
Exactly.
when there's a crash. I mean, like you've already said, I think next question we'll dive into, I've seen also, right? A lot of influencers already going online talking about how much they've invested in the last few days and, maybe how much profit they've made because the market made a V-shape, a slightly V-shape recovery, only to make it a W, I think, a few days later. But I've seen a lot of people just rushing into the stock markets in the early days, it's not even talking about a year, but in the first few days of it happening, right? I've also watched your content and you seem to take a much more conservative view this time. One of the statements that stood out in your video was, I'm going to read it out. So the stock market is a place where wealth is transferred from the impatient to the patient. So my question is really, why are there so many morph influencers and perhaps even ordinary investors gravitating towards this, buying the dip at the very first chance they get?
That's an extremely good question. It's a new phenomenon, to be frank. First of all, that quotation that the wealth is transferred from the impatient. The patient didn't come from me. I wish I'm so smart. Right? It came from Warren Buffett, of course.
I mean, I should have expected it.
It came from Warren Buffett. Certainly a huge fan and follower of him. I think that traditionally in the past, most people stay out of crashes and miss it completely. Now, over the last two rounds, there are people like myself, then a few other influencers, actually made money in the stock market by bottom fishing.
Right.
Okay, we caught the bottom and we are very public about it. And of course, because of our reach, people start being very hungry to follow this thing.
Yeah.
And other influencers saw that, wow, this kind of thing really attracts
the
a lot of
imagination.
eyeballs
Yeah.
and attention, and you really can make money out of it, and you can be multi-millionaires out of this kind of thing,
Right.
and all jump into it.
Okay.
Then they went the other extreme. They become too rash, too fast. Arguably, I could be wrong. Then, of course, at the first sign of a recovery, they make money out of it. They post out and say, I've made so much money, and things like that. Well, good for them. Good for them. I read economic signals because I'm an economist by training. And of course, this time around, I do see that if the situation aggravates, there are two precedents that's happened before. Number one is 2018. There was a trade war between US and China. At that very worst, the dip was 20%. Okay? And there was an even worse, which is 1930s, the Smooth-Hawley Act, where the market dived like 70-80%. Okay? That, of course, has a mixed effect of Great Depression and things like that, but massive downturn. So logically, okay, it will be a number somewhere minimally 20% because the scale now is much bigger and somewhere towards there. The only caveat is Donald Trump is unpredictable and he flips flops a lot. He make empty promises, and that's his strategy, I realized.
Yeah.
And he could suddenly say, okay, time out, okay, I play bluff, now you guys call my bluff. Everybody, peace from now on, and the kind of thing, right?
I mean, no one would be surprised if he came out
If he
and
does
said
that, no one will be surprised. It could be also everybody like, that kind of thing, right? And the market will have a V-shaped recovery to the moon, for sure.
Okay.
Okay? Then, of course, people like me who have missed out throwing big numbers in, were like, okay, I missed that dip of 15-18%, which is at the bottom of S&P 500.
Yeah.
I missed it. Okay, big deal, right? For me, it's okay. I still got a lot of cash. I still have a lot of stocks. If it goes up, I'm happy. It goes down, I'm happy. But I do think that most crashes last for a long time. Okay, most crashes last for a long time, and I think this has the potential to become very bad. And I do think that even if US want to be friendly, I think the world will not be friendly to him anymore. So from that angle, I think it's okay to sit back and wait for a while.
Okay.
There's no need to rush. As for those people who now flip the other way around, waiting to go for the queue and hopefully make some money just like all of us in the last few crash episodes, I think it's important for us to understand that, patience in finance and investments is extremely important. And it's okay if you miss it out. It will be, and by the way, it's also okay the other way around to invest, let's say, when there's a 5-10% crash.
Yeah.
And if you hold it for a long time, but trust me, very few investors are like that. They like to buy with a little bit and then sell on the high, buy a little bit and sell on the high. It's very easy for a person to say, don't worry, I'll be like Mr. Loo, hold for a long time. But an execution is kind of difficult.
Exactly, and that's exactly my next question as well. When markets crash, emotions usually run very high, right? So fear and greed are usually two of the emotions that are associated with it. Fear can paralyze investors to make any decision, whereas greed can, lead them to taking risky bets and even taking leverage bets, right? And we can go into that in a little bit as well. So do you think the average investor out there is even mentally and emotionally equipped to place such a buy the dip strategy?
Buying the dip is actually emotionally very difficult to execute. I recognize that. And unless you have got financial safety nets, you've got deep pockets and all this, I think it's it really requires a lot from your guts. It's very easy to say, right? Oh, when you go crash down by 10%, 20%, 30%, you go and buy. Because when it's at 20%, 30%, you will feel that you go to 40 and 50, right? And so it's something very difficult to execute. I have a good, very fun manager friend. He says that in order to do well in this kind of environment, you need to be 90% robot, 10% human. Okay? Which is true.
Taking the emotions out.
You gotta take the emotions out, right? So I asked him, are you fearful when the market goes down? He said, yes, 10%. Right? So I've evaluated myself. I think I'm closer to 70-30. And the 30%, is enough to kind of hold me back somewhat. The 70% will have some logic.
Right.
But that's after so many rounds of training in deep crashing and things like that. If you are first time, second time, I think the chances of you being able to master this skill, I think is really very difficult. So the advice I'll give everybody is, yes, it is a wonderful time to be fearful when other people are greedy, and be greedy when other people are fearful. Crash buy is the right thing to do, but you may want to try small sum first.
Yeah.
Right? $5,000, $10,000, or maybe 10% of a portfolio, 15, 20%, And I think that's okay, right? To throw your whole heirloom down, I think that's a bit risky.
Correct. The reason why people buy dips in the first place is because they want to take advantage of the better prices, the lower prices, right? So it just makes me think like, why don't more people, or why don't people who are not sure just go ahead and do a DCA strategy, right? Dollar cost averaging. So just buying each and every month regularly, regardless of the price. So in effect, this would take the dip, crash buying or dip buying into account. But why don't more people do that, you think?
Conceptually, DCA works, no doubt. And the theory is you just keep buying. Buy on the dips, buy on the high, just keep buying, in fixed interval or fixed amount or whatever, just keep buying. And if you buy the compounding asset, logically you will ride out the ups and downs. But it's very difficult to do as well.
Okay.
If you do it manually, it's the worst, right? So you come to every part, the time, the month they're supposed to buy, they don't buy. Or they buy too much, or they buy too little.
You still got to make that
because
decision.
it's very difficult to make a decision when the market is diving.
Yeah.
You will feel like, it's going to die,
Even more.
Yeah. So you either throw a little less or you don't even throw. And then when the market chong up, then you start to chase, right? Then you completely disregard the principle of DCA. So executionally, it is very difficult to do a DCA. Fortunately, a lot of robo app right now have a DCA function. I like that. But many people in execution intervene with the process. So therefore, it's back to what you say, greed and fear.
Yeah.
Right? So in that case, then we go for the second best solution, which is when it crash, okay, somewhere around the bottom, go for the kill. I think that's not easy to execute, but I think that is one decision or a few decisions you need to make in 1, 2, or 3 years, rather than to make a decision every month, and then you have a harrowing experience.
Yeah. I guess the other reason why DCA might work is because you can invest a smaller amount, right? So each crash, maybe you don't feel as painful each time it goes down as well. It's investing a smaller amount.
Again, that's conceptually the truth. I believe in DCA, don't get me wrong.
Okay.
The theory works. The execution is very difficult to execute. Yeah.
So we still need to find a way to automate that. Right?
Yeah. A lot of people start their DCA process on the rise.
Yeah.
If you have to start, let me challenge you, start on the fall.
Which is now. Now is
Which
a
is
good time
now.
to start.
That's a great time to start, okay? But you must commit, sumpah and swear to yourself and to your accountable to your wife, to your dog, to your cat, whoever, and say that I will be consistent, okay? And then you check back on yourself whether you're consistent.
All right, so you heard it from Mr. Loo. The best time to start DCA might be around now.
Yeah.
Okay, last question, I think we wrap it up. When it comes to buying the dip, I think we've talked about some decision criteria that go into you predicting or trying to predict close to the dip, right? So I'm just wondering, what are some things investors should consider if they want to replicate what you're trying to do, right? Figure out where is close to the dip. For instance, something that comes to mind, should we invest in more resilient stocks, broadly diversified stocks? Should we avoid certain types of stocks, especially maybe because during COVID, it was travel related we should avoid. Maybe now there's export related we should be avoiding. Are these things you think about, or do you take a more broad approach to identifying the stocks or the counters to invest in?
Let me tell you the truth. When the market crashed, we all love to become, Warren Buffett and Charlie Munger and Howard Marks and all the smart guys. We like to pick stocks. We like to pick counters. We like to pick industries whatsoever. Unfortunately, it becomes a gamble, and most of the time, in my experience, it didn't turn out well. In fact, I was with Sam Ree from Endowers. He's the Chief Investment Officer there, and he was the CEO of Morgan Stanley Investment and Asset Management, and he was an expert. Even he said that only when he was full-time in the job can he attempt to beat the market, and he has got resources, he's got access to a lot of tools and information that most of us don't have. But the truth is, most of us amateurs or self-claim semi-guru or whatever, we don't have the time, we don't have the resources and things like that. What makes us think we can beat all these guys, right? I think it's really difficult. So therefore, I go back to first principle.
I think that's what we want to hear. What do you do?
Just go for the old boring globally diversified index funds, right?
Okay.
The S&P 500, the NASDAQ equivalents for a bit more risk, the MSCI World Index, Dimensional Fund. There are so many of them, They all have a very, very long history of surviving crashes. Yes, they will dip, but they will rise again, okay? And I think those globally diversified index, okay, they are not as exciting in their recovery, but you know what? They work.
Okay, I think we've come to the end. Thank you for sharing your experiences, especially when it comes to, crash buying. So Mr. Loo, for those of you who don't know, also runs a YouTube channel where you can learn more about his 1M65 journey, as well as investment thoughts and insights that he has. So follow Mr. Loo on his 1M65 YouTube channel. So whether you're a seasoned investor or just started, I hope this discussion gives you something to think about and make a better financial decision for yourself. Thanks for tuning in. If you've enjoyed this discussion, don't forget to subscribe to the Dollars and Cents podcast, whether you're watching us on YouTube or listening on Spotify or Apple.